So thank you for that, Director. So what I'm going to speak about this morning is the review and outlook for inputs and crops. And I'm going to begin with an overview. So to begin with, I'll talk about 2021 in relation to inputs and crops, where we are now in terms of the farm gate. Talk about input costs, yields, price, gross and net margins. Then moving on to 2022 again for inputs and crops, and where we are going in terms of the farm gate in relation to input costs, yields, price, gross and net margins. So inputs review and outlook. So starting off with 2021, the year that we have just come through, and the overall headline news story for inputs is that price changes have been larger than volume changes for 2021. Fertilizer prices up 10% for the year as a whole, volume changes up 5% in aggregate across all farm systems. Fuel price, a different story, depending on whether we're talking about green or white diesel at the farm gate, with green diesel prices up 29% in 2021 compared to last year, and white diesel up by a less significant amount at 13%. Electricity prices also up at 10%, feed prices up 16% in 2021 compared to last year, and volume also up in relation to feed at up 8% in aggregate for the full year. Leading us to say that in total costs across the farming sectors has been up significantly in 2021, but the story will be very sector specific when we get the final National Farm Survey data for 2021. And moving forward to the input story for 2022, and the first input item that we're going to speak about is feed prices. So for 2022, we're forecasting more price increases for feed on top of that, which we've already outlined for 2021. And the feed price for next year really is a tale of two halves. And you can see here on the graphic on the left-hand side of this slide that over the course of the year, we're forecasting that feed prices will decline as the year progresses. But in H1, the first half of 2022, we're forecasting that there will be an increase in feed prices over and above the feed prices that were witnessed in the same half of 2021. And this really is a hangover from the 2021 harvest prices that we have just witnessed. But then moving forward into the second half of 2021, 2022, we're forecasting a decrease in feed prices compared to 21, but there's still very much large production uncertainties associated with that harvest forecast, leading us to say that overall there'll be a 6% increase in feed prices for next year for 2022. In relation to volume changes, we're forecasting no change to plus 7% on a per head basis, depending on the subsector that you're looking at. And really the differences between the subsectors is largely associated with this large increase that we're forecasting on fertilizer prices and how that will affect individual subsectors, but more about that later on. The next input item we're going to discuss is fuel prices, and again, inflationary pressure here evident with more price increases in 2022 for the full year. So fuel prices up for the year as a whole. And if we begin the story by looking at Brent crude oil prices here on the left-hand side, we're forecasting for the full year as a whole Brent crude oil to be up 16% in euro terms, slightly lower in US dollar terms, but that's to do with the exchange rate that we're assuming for the next year for 2022. But that's Brent crude oil. What about price transmission at the farm level? And to begin with, we need to take into consideration carbon tax increases that will happen next year, but also the transmission that happens to fuel prices as they happen at the farm gate, and the lag that's often evident between fuel markets and farm gate prices. So for next year, for 22, we're forecasting a further increase in green diesel of about 20% over and above 2021 levels, and white diesel up by 12% on 2021 levels. And sector specific price increases will take into account how important green versus white diesel is in individual subsectors. And then also to look at fertilizer. And I suppose fertilizer is a really standout story here for 2022, with unprecedented price increases forecasted in 2022 for the year as a whole. So price up significantly in 2022 for nitrogen-based products in particular, reflecting the gas price increases that Trevor has talked about earlier in his presentation. So nitrogen-based products were forecasted to be up about 120% on 2021 levels. P&K also up, but to a lesser extent than that which were forecasted for nitrogen-based products. The high prices that are prevailing in the fertilizer market at the moment are causing production uncertainties and fertilizer supply uncertainty in the market at the moment. And this will translate into very sector-specific stories depending on purchase timing of individual fertilizers and the product specification in individual subsectors. So to summarize the inputs for 2022, very large upward price pressure across the main input items. Fertilizer up by 120% in price terms, and then volume changes we're expecting between -20% to no change in fertilizer volume, depending on the sector that you're looking at. Fuel price up between 12 to 20% at the farm gate, depending on whether you're talking about green or white diesel. Electricity price up 5% for the year as a whole. Feed price up 6%, and volume change between 0 to +7% on a per head basis, depending on the subsector that you're looking at. With total costs then to be in 2022, very large increases in total costs, but again, a very sector-specific story. So to summarize our inputs before we move on to crops, for 2022, much larger price changes overall than that which we witnessed in 2021. Some volume changes also on a per hectare basis, which would be sector and whole farm specific. Overall upward pressure on prices, in particular feed, fertilizer, fuel and seed. So the implications of that will be very sector specific in terms of inputs, and that will be dealt with later on in the individual presentations. So we're going to begin with the margin story for crops, given the importance of feed for other sectors. So the crops review and outlook. In all the years that I've been presenting here at the annual review and outlook, this I think has to be one of the standout years for me, where we are estimating very significant increases in gross and net margins across our main cereal crops between the year 2020 and 2021. So on average, a 13% increase in crop yield per hectare, also significant increases in winter cereal area, and couple these two factors together have meant that there has been over a 20% increase in cereal production in 2021 compared to 2020. And then moving on to the international balance sheet, and the stock changes that have been witnessed have meant that cereal prices have also increased in 2021, with prices increasing between 21 and 33% in 2021 compared to 2020. Increases in direct costs at about 6% across our main cereal crops, resulting in a 90% increase in gross margin and approximately €525 per hectare increase in cereal-based net margin on specialist tillage farms, leading me to say that I estimate 90% of cereal farms will earn a positive net margin in 2021. And it's been a long number of years where I have said that that high number of cereal farms will earn a positive return from the marketplace. So just looking into that 2021 story in a little bit more detail for individual crops. So I've said previously, on average, a 90% increase in gross margin for our main cereal crops in 2021. And the reason for that is because of increases in yield, coupled with increases in price, moisture bonuses, straw receipts, and the newly introduced strong corporation measure. But remember, the margins that we're looking at here on the left-hand side are for 2021 compared to 2020, with 2020 being an extremely low margin year. So in 2021, we're looking at spring barley up €580 per hectare, winter barley up €750 per hectare, winter wheat up €950 per hectare. But around those averages, there is a large amount of variability, and we look into that variability a little bit more in the following slide here, where we're looking at net margins. So net margins being our gross margin, taking away all our allocated overheads. So again, a very positive news story here in 2021 for net margins. So what we're looking at here on the left-hand side in this graphic is the average base cereal enterprise and specialist tillage farms for 1/3 groupings based on net margin returns. So we have low margin farms, the bottom 1/3 of farms, then moderate margin farms, and our high margin top 1/3 of producers in terms of net margin. And what these figures are showing us is that the average return from the cereal enterprise in terms of net margin on specialist tillage farms in 2021 was €630 per hectare. That's what our estimate is, with high margin farms returning a net margin of nearly €1,300 per hectare and low margin farms returning €27 per hectare. Now that 27 could be viewed as being a low figure, but in a lot of previous years, I've been indicating that those low margin, that bottom 1/3 of farms were returning a very negative net margin from the marketplace. So this is a really good news story where we have a positive return in even that bottom 1/3 of farmers on specialist tillage farms. So moving forward then to 2022, and when we're talking about 2022, there are a number of factors that we need to take into account before we get to margins. And the first one is yields. So for 2022, we're forecasting production to decrease very slightly in Ireland, but also in European terms, very slight reduction in EU potential in 2022. So before we get on to why we're estimating or forecasting that for 2022, we need to do a little bit of a history lesson in terms of where we got to in 2021. So there was a decrease in some EU stock to use ratios in 2021, and this was resulting from an increase in EU wheat, barley and maize production, up about 4.5% for the year. But there was also a very significant increase in demand for wheat and maize, leaving some stock to use ratios at historically low levels. So this led to a large increase in wheat and barley prices at harvest 2021. So now the question we ask ourselves is, do we think that the 2021 global harvest will be replicated in 22? So what we do know at the moment is that the latest statistics are showing us that there hasn't been much change in winter plantings across the EU. We're also forecasting a return to trend yields in 2022, which would give us a lower Irish and EU yield potential when we put this information together. And that's depicted here in the graphic on the right-hand side, where the latest information from Strategy Grains is telling us that the forecasted production for next harvest will be slightly lower than what we have come out of in 2021. So when we use that information on production forecasts to come up with price forecasts for 2022, that's what we're doing here now in the next section. So for 2022, we're looking at forward prices for 2022 from the futures market. And forward contracts that are prevailing out there at the moment are showing that wheat price will increase by about 2% at harvest time 2022 compared to 21, and that's depicted here in the graphic. Here in blue, what we're looking at is the historic prices from 1997 up to 2021, and then the predicted price for 2022 shown there in the red dot, which is up 2% on the 2021 price. But for those of you that are seasoned attenders here at the annual review and outlook, you'll know that I also put a confidence interval on that forecast. And I look back at futures markets over the last number of years to see how right or wrong the futures market has got it. And we use that information then to put this confidence interval on our 2022 forecast. And depending on how right or wrong we think that the futures market will get it for next harvest, we're saying that price could go as high as €270 per hectare, or as low as, or €270 per tonne, or as low as €170 per tonne next harvest. So just to put a little bit more context on that inflationary price pressure, which is slightly positive at +2%, what we're doing here is looking at bullish and bearish factors which potentially could influence the 2022 price. So we're saying slightly positive news at +2% for cereal prices next harvest. And the factors which are contributing to that positive price point is factors such as the La Nina, weather event, which is put at a moderate risk of happening over the coming months. We're assuming trend yields. We're assuming exchange rate and supply chain difficulties, which will lead to inflationary pressure to the tune of 2%. But on the more bearish factors or the more negative factors in terms of farm gate cereal price, you could think of factors such as grain quality and moisture, which we think will have will be in a less positive position for cereal farms next harvest. We're thinking that market fundamentals will be more in balance and there will be less panic buying in 2022 if those market fundamentals are more in balance. So overall, the bullish factors are outweighing the bearish factors. So we're forecasting plus 2% in futures prices for contract prices for next harvest. So the final component that we need to look at before we get on to margins is costs. And I've already outlined this story earlier in the presentation, but just to recap from the point of view of cereal farms. Overall, a very large increase in direct costs forecasted on cereal farms in 2022, with fertilizer up 100%, seed up 60%, machinery hire up 10%, and crop protection up 1%, leading me to say that our forecast for 2022 is for direct costs to be up by 35% on cereal farms next year. And here on the right-hand side, we see the graphic displaying direct costs per hectare for our main cereal crops, which are all significantly increased on the 2021 level. So finally, the last calculation is margins and our forecast for margins for cereal farms in 2022. So overall, we're saying a decrease in 2022 gross margins. So gross margin to decrease by €315 per hectare for spring barley, and to decrease by 610 for winter wheat and 470 for winter barley. So significant declines in gross margins for 2022. And that story is replicated when we move on now to net margins. So we're forecasting that the net margin for the average cereal-based enterprise on specialist tillage farms to decline by over €350 per hectare next year, which is depicted over here in the average on the right-hand side of this graphic. And we also see the story for our low, moderate and high margin farms here depicted in the graphic. But overall, a negative news story as we move from 2021 into 2022 with respect to cereal farming. So just to summarize now, our forecast for 2022 is based on the highest probability that prices will increase marginally at harvest 2022 by about 2%, but there are still very much uncertainties around that 2022 price at present. We're forecasting a reversion to trend yields, which would mean a slight decrease in yields over those achieved in 2021. Direct costs to increase by an average 35%, which would lead to an overall decrease in gross and net margins next year, which would return a net margin for the average cereal-based enterprise of €258 per hectare in 2022, which would mean that the average base cereal net margin on specialist tillage farms will be negative on about 40% of specialist tillage farms next year. So that completes the review and outlook for inputs and crops, and I'll hand you back now to our director, who will introduce our next speaker.